Hey, folks, welcome to InTheMoneyStocks.com's daily analysis video, brought to you by the creators of proprietary price, pattern, and time methodology. Learn the PPT strategies and profit for life. My name is Gareth Soloway, Chief Market Strategist here at InTheMoneyStocks.com. All right, everybody. Well, how about this? Markets getting clobbered, lows of the day as the markets have about 25 minutes left in the day. We are approaching an intraday support level on the S&P 500. But what's amazing about today is that we opened sharply lower after the CPI data, and CPI data insanely hot, right? Meaning more inflation than even the market thought. It was even more than I thought was going to show up. I thought the numbers might have been kind of in line with estimates, but they did blow the estimates away. Inflation more and more. The Fed is going to have to act faster and quicker, and the markets are pricing that in. The 10-year yield surging above 2%, right now trading at 2.033%. So again, we have not seen a 2% 10-year in over 2 years, folks. And again, the markets are in unwind mode. Now, again, we were smart enough, or I was smart enough, I should say, to take some profits this morning. This morning, Twitter came out with decent numbers. The stock at one point was north of $40. By the time I got out, it was about 38.75. That's fine. We still banked over 10%. SQ, we unloaded at 116.05. For a 14% gain. Well, let's take a look at where those stocks are trading now. This is the fun part, folks. Take a look. Twitter is now negative on the day, about $1.50 away from where we unloaded it. But the big one here, take a look at Square, back to 108, over $8 down from where I sold. Now, even after I sold, it actually went as high as 119, which was pretty remarkable, almost $3 higher than where I exited. But the bottom line is, you just can't trust a bear market, folks. And again, I've said this to you guys for a while, is that this isn't a buy and hold market anymore. This is a bear market. The markets are readjusting. They're adjusting to the Fed being more hawkish, to removing liquidity from the system. Essentially, what's going on is deleveraging of the system. And when I say deleveraging, I'm talking about not just crypto, not just stocks, but I'm talking about debt, people's debt levels, companies' debt levels. I'm talking about housing prices. All right, just think about this, folks. The move up here, we've had a huge move up in the 10-year yield. 30-year has gone up. The 2-year has gone up as well. I mean, all of these are affecting the home value, essentially home values, because they're already, home prices we know are ridiculous at this point, right? But now what you're doing is you're making it even harder for people to buy, because when they take a mortgage out, that interest is even bigger on a monthly basis that they're paying. So, maybe it was going to be a $2,000 mortgage payment when interest rates were 1.2%. Now it might be a $2,300 or $2,400 interest payment when it's jumped up, right? So you're creating an even harder scenario for home prices, which again, as I explained to you prior, I sold my home in Oregon a while back last year in August, I believe it was. And again, moving like that, I'm renting now. Now, listen, again, I'm a trader, so I don't necessarily suggest this for everyone. But again, for me, it's like, all right, I don't mind renting, no responsibilities of yard work and all that crap for, a year or two, and then just wait patiently for housing prices to come in 20, 30%. And be able to scoop something up at that point. By the way, at some point, housing prices are even going to come in a lot more than that, but we'll see how long my wife lets me get away without us having a house and living out of a smaller apartment. We'll see. All right, going back to the markets here, going back to the SPY, let's take a look. We just tagged that support level. As a day trader, you can focus on that level. That is a level. You can see the bounce coming in. Again, lows of the day, almost down 1% on the S&P 500. Qs are getting roasted, which makes sense, right? The QQQ being the tech sector. We are seeing tech stocks across the board. Facebook's back down about $5 today. Microsoft's down 10. Apple's down 360. Google's down 67. Amazon's down 53 points. And even Tesla down about 27 on the day. As again, tech is what gets hit the most when you have higher interest rates, right? It reduces the amount that companies or investment managers are willing to pay on that, essentially for that valuation. So again, it might have been acceptable to have a 50 PE ratio when interest rates were 1%, but at 2%, it might only be okay for a 35 PE or a 30. I mean, again, I don't know the exact level that these managers have in their mind or what things are pegged to, but that's basically what's happening here. Higher interest rates means lower values for valuations on stocks. All right, so again, pretty wild stuff here. The Russell here, let's take a look at the Russell. The Russell is taking a beating as well. Remember, yesterday we did take our TNA off the table for a beautiful gain. Look at what the Russell just hit, guys. What level is this? You should all know this would be considered a gap fill. What's interesting, the market opened, the IWM opened today so close but never filled. I'm telling you right now, more often than not, when you open close to a gap fill and bounce, inevitably you'll come down later that day in this case, but it's very soon after to fill the gap. Gaps are meant to be filled. They work as a magnet. I was actually shocked when the markets rallied today early out of the gates. If we look at the spiders again, the spiders briefly went green, and I even told this to the live day trading room. I said to them this morning, I said, this doesn't make any sense. Yields are surging over 2% here, or about 2% at the time, and you're seeing the markets go green? No way. I said, don't be surprised if we make new lows later in the day. Lo and behold, what happens? We made new lows later in the day here. All right, and again, this is just knowing how the markets work, understanding the market metrics, understanding how institutions and managers have to manage their book based on interest rates. And it made no sense that we were seeing what was going on earlier when we surged all the way up here and basically went to gap fill, and then look at the market since then. All right, now, one of the key questions that I'm kind of delving into is, well, how high are interest rates going to go? I think 2.2 to 2.25 is my upside. I honestly don't think they're going to go much beyond that. We could even hit that by early next week at this rate, although, again, I do think, we might pause for a little bit before making one final move up. But the idea here is this. The government, the Federal Reserve, they can't afford to have interest rates go up too high. All right? They just can't. Okay? So, remember, we have a ton of debt as a country. The debt payments on that debt are going up by the billions, considering the amount of debt that we have, the higher interest rates go. So there will be a concerted effort to not let interest rates get too out of hand, but the Fed has to juggle higher interest rates to try to curb inflation with, higher interest rates that are hurting the debt factor. So again, this is now, this is the box that the Fed has put themselves into. I've been screaming about it for years that they were doing this, and again, they're now in this pickle. And, how the hell are they going to get out of it? Honestly, I don't know. I don't think they ever will get out of it. I think, again, it's going to be a kind of a whack-a-mole. Which one's worse? Is inflation right now worse or unemployment worse? Right now, inflation is worse. So they're going to let interest rates come up like this to try to curb inflation. As soon as that starts to hurt the economy via the stock market going down enough, which then will translate into the wealth effect disappearing and people feeling poor because their 401ks go down 20%, 30%, then they buy less goods, which translates into less goods being sold by companies, therefore layoffs, round trip it, unemployment goes up. So now you have unemployment going up, maybe inflation's come down to 5%. I'll bet you the Fed starts attacking unemployment and saying, okay, well, we can deal with 5% inflation. Now, for me, I don't want to deal with 5% inflation, and right now it's 7.5% inflation. But the Fed is going to look at it that way. Which one at this particular moment is worse? Let's deal with it. And it's unsustainable, because what you're going to get is you're going to get constant rises, right? So unemployment will go up, and then they'll print more money, then inflation will go up more, then they'll start to, and so inflation will come down a tiny bit, but instead of going to like 4 or 5%, it might only come back from 10 at that point down to maybe 8. And then unemployment's going to spike again to like 10%. Then they're going to say, okay, well, we got to do it. And it's going to be, each number is going to eventually go higher as they kind of whack-a-mole back and forth. And ultimately, it's going to cause an epic collapse. The system is going to have to be reset. That's just the bottom line, folks. And it's going to be nasty, but we're here to trade through it. We're here to keep ourselves diversified. I love gold. You guys know I've said that. Eventually, I love cryptocurrencies. I love, there's going to be other investments. I've said this before to you guys, but foreign stocks right now, fund managers are unbelievably underweight foreign names like China stocks and South American companies and various global names like that. And again, even today, we're seeing Chinese stocks hold up relatively well considering. They're pulling back a little bit, but considering the recent gains, they're holding up very, very nicely. By the way, did you guys see Affirm today? Remember, we had Affirm. We had a nice gain on it. But basically, they by accident released earnings early. The stock went from being as high going into earnings as 83.5 down to $50, then back to 66 here, then back to where it is right now at 59. I mean, this volatility is insane. And again, it's a great trading environment. I mean, listen, we're having like one or two winners every single day, it seems like almost, which is nice. But at the same time, man, if you were a long-term investor, what the heck? I mean, it's got to be like watching your head spin and your account just kind of fluctuate in massive amounts just back and forth. All right. In any case, let's go to the daily charts and quickly delve into this stuff here. So here's your daily chart. Notice the high of today, folks. I think this is interesting. The high of today basically was a triple top right there. We never got through that line. That'll be a level to watch if we do start moving up, right? So if we take that out, then I do think we get back to this upsloping trend line, wherever it may be. But honestly, I'm not sure if it'll happen. My overall longer-term bias, my midterm or whatever you want to call it over the next month or two, is more downside in this market. It's possible it's already started here. My only regret is that we didn't go high enough for me to grab, shorts on the S&P 500 and the NASDAQ. That's okay, but ultimately, I'd love to have gotten a little exposure there, but it just, when the charts don't align, they don't align. I'm not going to force a trade in that respect. In terms of support, we have a very clear level right here, right around 444 to 445. If that gets taken out, you got to think you may go back down to the 428 level down here, okay, and then eventually down to 420 or just above 420. If we want to go and zoom out and see where this market is eventually going on the S&P 500, to me, there's no doubt in my mind here, and then eventually pre-COVID levels, which happen to be basically right in the middle of this range. Remember, this range is your long-term growth range in the market, and it only makes sense. And I've been screaming this at the top of my lungs. I know you guys have heard it, but if you're really removing the liquidity that was created for COVID, then doesn't it make sense that we go back to the longer term trend that the market was in prior to those stimulus procedures? And the answer is yeah, it does. It does. In fact, if we, as I said yesterday, if it causes a recession because the Fed hikes too much, well then guess what? We're going below that trend. I mean, what's kind of freaky here, and I've never shown you guys this, but I would not be shocked if you could replicate, think about this, replicating this move here to like this, right? These parallel lines. And imagine if the market came all the way down here and then, and I should have drawn that straight. That's annoying that I didn't do that. But, so basically you have this type of channel, which was the same channel going up, but we come all the way down inside of it, and it's hard to do it straight and still show it, but imagine we do something like that. Wouldn't that be shocking and crazy? That would be kind of the overshoot, recession, depression-ish type scenario where, imagine the spiders going from 480 up here down to like 180 down here. And it will happen. I just don't know when. The timing is going to be the toughest thing, as it always is to, basically call. All right. In any case, that's where we stand on that front. Let's go to the QQQ chart. Daily Qs continue to be kind of hovering at the lower end of this range. If we come back down and take this out, game over. That's your next big leg to the downside. Where would we go at that point? Well, you'll have lots of supports along the way. This would be a major one here, right? 300, you have this pivot high right here and this pivot low. They match up. That tells you that's a big level. This was our previous level right here, right? So you can see how this area right here translated into that, plus the upsloping channel right there. So this would be your next big stop right here. You have a minor level right here. This would just be minor, but that would be a minor level around 320. And then finally probably down to 260. And then eventually, you got to figure, pre-COVID, 240, sub 240 on the Qs. Think about what some of these stocks will be valued. What's Apple at if we're at 240 on the Qs from 357 right now? You got to think Apple again. And I don't know if you guys remember, but I'm short Apple. But if you remember, my long-term target on Apple was about $90 to $95, and I still think it's going there. All right. And again, it would have to drop, about 50% or so to get there. But I think it's going to happen. Again, think about Facebook, what it did. If Apple ever disappoints, it's going to get there a lot faster. But if you look at Apple on a longer-term basis here, this is what I'm looking at right here. See this gap right here in this little pivot area? This gap fill, I think, gets filled at around $95, $96. And again, what's crazy about that is if you look at Apple's longer-term trend, that's actually not that ridiculous. What would that be, about a 50% retrace? Not that crazy. So, anyways, let's go to the Russell real quick. And again, I'm glad we took profits on the Russell. Again, we were talking about resistance here. Interestingly enough, look at where the Russell was at the highs of today. Again, charts are just awesome. Here's your high. Look at the little tail right there. basically kissed that 210 level. We got to 209.05. And then look at the reversal on the Russell. Russell's now down 2%, getting smoked here into the end of the day. Let's go quickly to Bitcoin. Bitcoin was actually hanging in there, still below the 46,000 level. It's now at 43,800, though. Why? Well, because the tech stock sold. So this morning, before the market opened, before the CPI number at 8:30 in the morning, we saw Bitcoin actually pushing up towards 46,000. And then as soon as that CPI number came out and the market started to tank, it started to bring the Bitcoin chart right back in. It's amazing how levels coincide. I mean, again, just another great example of how this level here and then these lows right here. And again, did I know the CPI was going to cause a sell? No, not at all. But it's just, it all coincides somehow. Somehow it does. The charts are almost like a predictor of the future of what's coming in. You don't know what's going to cause a sell-off off of 46 or 45,000, but inevitably the chart says something's going to happen, and it seems to happen more often than not by quite a large a bit. All right. Next up, let's take a look at gold. Probably my favorite and continues to be my favorite asset in this crazy time. If you had to pick one, stock market, S&P 500, essentially Bitcoin or gold, gold is the one to go. It has been definitely the most stable. Like, think about if you were in gold just since January, you're sitting pretty. All right, Bitcoin has been insane, big drops there, some big bounces more recently. Then you look at the stock market and the craziness there, and then what's gold doing? Oh, it's just chopping sideways in a very tight range, basically a $50 range on gold. That's what it's been doing. Amazing, right? So, anyways, do I expect a breakout? Yes, I've covered this a million times before. I continue to expect that breakout sooner than later, too. Silver, a little bit of a sell-off today. Not a topping tail because it's not the highest point on the chart, but nonetheless, nasty reversal there. The only thing that I care about on silver is this 2150, 2175 level. We'll see if that holds, if it does come down there again, and then do we finally break to the upside. The big level you're watching on silver, at least the interim big level, would be this trend line here, okay? And then if it gets up through that, then you're starting to watch this 30 or just below 30 level on silver. Lastly, oil, guys. Let's take a look at oil. And again, oil was stronger. It was getting a classic retrace here. And then it started to sell. Why did it start to sell? Well, everything's selling. So again, this is where emotion becomes bigger than any one thing, right? When you see, stocks or when you see any of these things just get too powerful or the emotion in the market get too negative. It's why, in all fairness, when COVID first started, when that March of 2020, you saw gold sell off too. Even though gold is a safety asset, it sold off too. Now, it recovered very quickly and ran up beautifully, but for that initial fear and panic, everything sells. And, gold's no different, silver's no different, oil's no different when panic hits. And I wouldn't say now is panicky, but obviously, we know that the oil chart was into a major level. I've talked about that with you guys of why I added to my SCO chart position here. Because of this, there's also a secondary level over there. And then bottom line is you match up the chart with the fear developing in the market over that CPI number, and you're getting a sell-off there. All right. On that note, guys, I'm going to bid you farewell, but wow, oh, wow, what a crazy market we live in for sure. Let's do one more check on the S&P 500 here. In fact, we'll go back to my other chart, my intraday chart, and you can see there's a firm just doing its thing there. But if we look at the spiders here, guys, we did go lower than that gap fill, that pivot low after initially bouncing, and now we're bouncing right back to that line. So that line seems to be where the market may want to close itself here. Nasty sell-off, again, over 2% on the equity side on S&P. The NASDAQ, again, worst sell-off, 2.5% drop. And again, one of the things to remember is, you had a nice move up here just yesterday, but we've wiped that out, and that's never a good thing. When you have a good move up and the next day you wipe it out and then some, never a good scenario. It doesn't mean they can't bounce the markets tomorrow, right? It's always a possibility, but again, it's just an overall sell side signal overall. All right, have a good one, guys. Thank you as always. I will keep you posted.